Hi and welcome to this Blueprint Markets video update with me, John Kibler, head currency analyst. In this video, we're going to be taking a look at gold as the price jumped on the recent FOMC meeting. So the Federal Reserve announced a rate hike, and we saw that they announced a hike of 75 basis points, moving the Fed's fund rate from 2.5% to 3.25%. Now this was to be expected. There was a slight risk of an 100 basis points move. That was basically down to the fact that August CPI data came in higher than previously expected, which could offer the Fed an opportunity to raise rates by more than 75 basis points. But that wasn't had to be the outcome. Instead, we saw 75 basis points. Now, in the press conference after that, there was some talk of further hikes to come, with some expectations now that by the end of the year, the federal funds rate will be close to 5%. So, if that's the case, there is still 1.75% to find in the next coming meetings. So, that's still very hawkish from the Fed, and we could likely see the dollar continue to strengthen for or at least till the end of the year. What does that mean for gold, and does that mean that the recent jump in price is only going to be short-lived? That's what we're going to be looking at here, the reasons why and what could happen next. So, looking at the price of gold, what happened? Well, we saw price move towards the lows here at 1654, but then rallied back to the upside, breaking through the consolidation highs of 1680 and eventually reaching a high of 1688. We actually saw there was actually a bit of a resistance here at 1686, which I'm going to show you in a second. But you can see here the path of gold at the moment is definitely to the downside. The market making larger swing lower highs and larger swing lower lows, and that sentiment is likely to continue as the Fed continue their path of hiking interest rates. Now, the reason why we're probably seeing a consolidation here is because if I just jump up to a weekly time frame, you'll see we're at the range lows of this weekly range that we've been in for some time now. So usually price at the lows will find some kind of buyers, but fundamentally, is it the right time to be a buyer of gold? Perhaps not. Maybe we'll see price sink a little bit lower towards the $16.27 or $16.30 before seeing a bit of a bounce or seeing the continuation down to $1,500, depending on, again, what is the Fed's plans in the future. Now, if I just go to a 30-minute time frame, what I've got highlighted on the charts are the US session volume profiles, and you can see that price rallied, hit a point of control from the 15th of September US session profile, and we rejected here. Now, if you weren't using volume profiles, you may not have noticed that there would have been a resistance there, and may have tried to buy with the momentum to the upside. That's where a lot of retail traders get caught out. Instead, you can see price hit that area, it reacted as resistance, and we've traded lower back below the range highs. So if price does remain below the range high at 1680, I do think that would offer a bit more selling pressure than buying pressure for gold at the moment. If we do see price break 1654, then that 1630 is definitely on the cards. If, however, sentiment changes for whatever reason, and gold is seen as more of a safe haven, then a break above 1688 will see price towards $1,700, maybe even to 1730s. Hopefully that made sense. If it did, leave this video a thumbs up. Subscribe to the YouTube channel to see some more Forex trading content, and I'll catch you in the next video.